Welcome back, friends. My name is Deepak More and you are watching my YouTube channel, TheIndianOptions.com. Today we are discussing a very advanced strategies and the video's name is Straddle and Strangle. Okay, this video is really very complex and I'm assuming that you have already seen all my previous videos, especially the option basics and basic strategies and trading behavior and things like that, because that knowledge is required in this video also. So I'm not going to repeat that knowledge again here because it will just, this video will be really very long then. So I'm assuming that you have already seen the video, you already have the necessary language or necessary knowledge to understand this, and then understanding that and taking that as an assumption, I'm moving forward. So going to the next slide, straddles and strangles. Now these names are really very weird. It's difficult to understand, difficult to remember, and we don't know what they mean basically. Okay, and but that's what it is. You just have to remember, there is no other this thing. Straddles and strangles. These straddles and strangle, this we are using this very often, and even like before even knowing that this is a strangle strategy or straddle strategy, you might have used this strategy even before knowing about this, right? So this is a very common strategy. It's not really that difficult to understand because uh, uh, it's just very simple as compared to the other butterfly and condor and vertical spread and things. As compared to those strategies, this strategy is really very simple. Okay, so straddles and strangles are both option strategies that allow an investor to benefit from a significant move in a stock price, whether the stock moves up or down. Okay, both the options are consist of buying an equal number of call and put options with the same strike expiration date and same strike price actually sometimes. Okay, the difference is that the strangle has two different strike prices and the straddle has a common strike price. Okay, straddle has common strike price. Just keep in mind only one sentence, that straddle and strangles, either which it is are the option strategies which allows you to take benefit from a significant move in the stock price, significant move in the stock price in either upside or downside. Okay, it doesn't matter. Okay, so both the approaches consist of buying an equal number of call and put options with the same expiration date. The difference is that the strangle has two different strike price, straddle has one common. So we'll just see one by one. Okay, and there are again two flavors each. So one is long straddle, short straddle, long strangle, short strangle. We'll go through one by one on all these things. So first one is long straddle. Now in this you see that we are picking up 12,000. I'm just taking 12,000 strike price as an my example, and on the left side it is you know that there is a this is option chain, right? On the left side we have a call side and right side is put side, and on the call side you will see that 12,000 is in the money, which means on the other side, on the put side, it becomes out of the money, or vice versa, whichever way is okay. So if you would have chosen like 12,300 as a strike price, just for an example, bear with me for a moment here, in that case the put side would have been in the money and the call side would have been out of the money. So either which ways is okay, no problem, doesn't matter, but the strike price has to be same. Now in this example we have taken it as 12,300, and so put side it is 38 rupees and call side it is 120 rupees dot 50 paise, and so the total amount that you are paying, now this is a long straddle, which means you are buying this one lot each on both the sides. So the maximum money that you are going to pay is the addition of both the premiums, so that becomes 159 rupees and 30 paise. So this 139 rupees is what you are paying to open this straddle. Okay, now if we can calculate the lower break-even points and upper break-even points very easily out of this. Now here what has happened is, here we are assuming that the market is going to be above. It can go either way. It can go below 12,000, it can go like 600 points below 12,000, or it can go 600 point above 12,000, doesn't matter. In this strategy we are assuming that the market is going to go either up or down. Okay, doesn't matter, but it should not stay at 12,000. If it stays at 12,000, then you are going to lose all the money that you have just paid, because in this strategy you are assuming that the market has to go either very below or too much above, in either direction. So in a very volatile market, right now due to coronavirus, our markets are really up and down like anything, without any logical explanation. Then in this situation we can use this strategy actually. Okay, and you can really make very good money out of it. Now here upper break even point is like 12,000 plus whatever you have paid. So you have paid 159 rupees. So the upper break even point becomes 12,159.3, and the lower break even point is 12,000 minus 159.3, that is 11,840.70. So your maximum loss is going to be 159.3 if the market stays at 12,000. Okay, that is maximum loss. And maximum profit will be achieved anywhere where the market breaks this break-even points and goes below 1,000 points, doesn't matter, above 1,000 points, doesn't matter, as far as it breaks the break-even point levels. As soon as it breaks, it will go anywhere. Okay, so this is the long straddle. Now in short straddle, it is exactly opposite of long straddle. Now in short straddle, what happens is we sell one contract, and we sell one contract from the put side, one contract on the call side, and if the market stays inside these break-even points, then you are going to make profit. If the market goes below the strike price, or the market goes above the upper strike price, then you are going to make loss. So and that is going to be very big and unlimited loss. It is called as unlimited loss. So short straddle is bit risky as compared to the long straddle. Now in long straddle, your profits are unlimited if it breaks those break-even points, but your loss is limited. Loss is how much, whatever that 159.30 rupees that you had paid, that becomes your maximum loss. In this situation, your maximum profit becomes 159.3. Okay, and you are assuming that the market is going to stay inside these boundaries. If it crosses these boundaries, then you are going to make loss on either side. Okay, in either side. Okay, so again the break-even points and all those are same. Maximum profit is what you are actually going to get, or what you have already got, that is the maximum profit. Maximum loss will be unlimited. So this is just the difference between long straddle and short straddle. Now let's go to another strategy called as long strangle. Now long strangle also, it is exactly same. Only thing is that in initial straddle we had only one strike price, that was 12,000. Now in the situation of long strangle, we have two strike prices. So here in our example, we have taken the two strike prices as 12,000 and 12,200. And exactly again same thing. The higher break-even point is 12,267, lower break-even point is 11,932.95, and in this you have actually paid 67 rupees and 5 paise. If you add both the strike prices and both the premiums together, So it becomes like 28 rupees dot 25 paise plus 38 rupees dot 80 paise. That is what you have paid initially, and those are the break-even points. So max profit will be achieved if the market breaks either of these break-even points. So if it goes below 11,932.95, then you will make profit, or if it goes above 12,267, then it will make profit. And if it stays in middle of this, then you are going to lose both the profits, both the premiums. Okay, so the maximum loss is whatever you have paid initially, so you don't have to actually worry about it. You have already accepted that loss in your heart, so you are prepared for it, so nothing to worry. If the market goes above this break-even point or below this break-even point, you are going to make money. Okay, now the last one, short strangle. Now short strangle is the strategy that we had studied in our basic section as well, in which I had explained about the 3-week strategy, and I had explained the 3-week strategy. In that I am using this same thing, right? Now this is one of the best and one of the safest strategy that I use, and this strategy is also used by the beginners a lot, because it's really a very beginners kind of strategy that has to be used with the minimum risk and minimum profit. Now in this situation, if you see again as the same long strangle, you are getting maximum 67 rupees and 5 paise in this, but your loss is going to be as soon as loss will start if unlimited loss they say, but actually it doesn't happen that way. In the short strangle, the maximum profit that you are going to get is 67.05, and the maximum loss you are going to achieve when the market breaks either of these two. Okay, so just please remember that. And if you don't want to play a really very risky game, then you can take the strike price. You can increase the gap between the strike prices by 400, 500, 600, whichever way. Now if you say, for example, now here when I took this example, the time decay time decay is very less, so that's why the figures are really very less, because I think so the market will close in 3-4 days. That's why the premiums are like 28 rupees or 14 rupees. But if you take like if you go below premium, this is 900, 800, 700, so 11,700. Now here it says that it is 3.65 rupees, 3 rupees 65 paise. But if the now in this option chain only 3 days were left to the expiry, that's why it is small. But even if you go like 400, 500 points below or 400, 500 points above, you still get like 50, 60 rupees, and that is really very safe, because the market doesn't do that much changes if the volatility is low. This is actually a very best strategy, and just have a look into this and just understand what we are trying to say here. And that's about it for this video. Please share this video with your trader friends or whoever wants to learn more about this, and I'll upload this on my website www.TheIndianOptions.com, so please download it from there. Also please subscribe to my YouTube video, the button is right here, and thank you very much, and you have a nice day. Bye bye.